What we're witnessing right now in silver is not chaos, even though it's been sold that way. It's structure. It's a market that has just gone through an intentional reset, the kind that only happens before something big. Over the past stretch, volatility didn't appear randomly. It arrived precisely where it needed to. Sharp drops, fast rebounds, sudden fakeouts. All of it worked together to shake out weak positioning and clear leverage from the system. That's how markets prepare for a sustained move. They don't climb when everyone feels comfortable. They climb when conviction has been tested and patience has been punished. Look at where price has been living. Every time silver dipped into key support zones, buyers showed up quietly but consistently. Not with hype, not with headlines, but with volume that tells a story if you're paying attention. These aren't emotional retail reactions. These are calculated entries. You can see it in how quickly downside momentum stalls, how selling pressure weakens with each retest, how candles shorten and volatility compresses instead of expanding. That's absorption. That's a market being accumulated, not abandoned. Momentum indicators reinforce the same message. We've moved from overheated conditions into neutral to constructive territory without breaking structure. That matters. Historically, when silver resets momentum like this while holding higher range support, it's not a sign of weakness, it's a spring being coiled. The market needed to breathe, and it just did. Now it's loaded. Zoom out, and the pattern becomes even clearer. Resistance levels that capped price for months were tested, rejected, then revisited. Each time, the rejection got weaker. Each pullback became shallower. That's not failure. That's pressure building. Markets don't smash through ceilings on the first try when the move is real. They lean on them. They stress them. They force sellers to reveal themselves. And right now, there are fewer sellers left. Another key signal is range compression. Silver has been trading inside tightening bands where volatility keeps getting squeezed. That's not random, and it doesn't last. When price is compressed like this after a violent move, it almost always resolves with expansion, and expansion favors the direction of accumulation. This kind of setup doesn't resolve sideways. It resolves decisively. The only question is timing, not direction. You also have to consider how clean the levels are. The market respects them almost too well. Bounces happen exactly where they should. Pullbacks stop exactly where prior resistance turned into support. That kind of technical respect tells you algorithms and institutional models are engaged. This isn't emotional trading anymore. This is structured positioning, and structured positioning points toward a predefined target. That target isn't pulled from thin air. It's derived from measured moves, from prior consolidation ranges, from breakout projections that have played out again and again in silver's history. When you overlay those projections on the current setup, they converge. Different models, different methods, same destination. That convergence is rare, and it's powerful. What makes this even more important is what didn't happen. Silver did not break down. It did not invalidate the broader structure. It did not lose long-term trend support. In a market flooded with fear narratives, that resilience speaks louder than any headline. Weak markets collapse under pressure. Strong markets digest it. Every major silver move in history looked confusing right before it became obvious. There's always a phase where people say it's dead, manipulated, finished. That phase is not a coincidence. It's required. Because big moves don't reward certainty, they reward preparation. Right now, the technicals are not screaming panic. They're whispering opportunity. And as this compression continues, the energy keeps building. The longer price stays coiled, the more aggressive the release becomes. When it goes, it won't move politely. It won't wait for consensus. It will move through levels quickly, forcing late entries to chase and skeptics to reprice reality in real time. This is the point where patience matters more than prediction. The setup is already in place. The groundwork has been laid. The market has done the hard part. All that's left is resolution. And when it comes, the next price target won't feel surprising. It will feel inevitable.
Now zoom out beyond the chart, because this move isn't being built by lines and indicators alone. The real pressure is coming from underneath the market, where physical silver lives, moves, and gets consumed. This is where the disconnect becomes impossible to ignore. Paper prices can be pushed around for a while, sentiment can be managed, and narratives can be shaped, but physical reality doesn't negotiate. It eventually forces alignment, and that's exactly what's happening now. Silver is not just an investment asset, it's a necessity. It's embedded in electronics, energy infrastructure, medical applications, defense systems, and the technologies governments say are non-negotiable for the future. Every solar panel, every electric vehicle, every advanced circuit increases demand that cannot be deferred. You don't substitute silver away without sacrificing performance, and industry knows that. Demand isn't slowing because price volatility doesn't stop production lines. Orders still get filled. Contracts still get honored. Metal still leaves the vault. At the same time, supply is not responding the way textbooks claim it should. Mining output isn't surging. New discoveries aren't flooding the market. Projects take years to bring online, and many of the easy deposits are already gone. Add rising extraction costs, regulatory pressure, and geopolitical uncertainty, and supply becomes rigid right when demand is accelerating. That imbalance doesn't show up immediately on a price chart, but it builds tension in the system. Now layer monetary reality on top of that. Global debt continues expanding, confidence in fiscal discipline continues eroding, and currencies are being managed rather than trusted. In that environment, institutions don't run toward promises, they run toward tangibility. Silver sits in a unique position here. It's affordable enough to be accessible, industrial enough to be indispensable, and monetary enough to be trusted when confidence cracks. That combination makes it impossible to ignore during periods of systemic stress. What's especially telling is how physical premiums behave when paper prices dip. Instead of collapsing, they hold or rise. That's a warning sign. It means the quoted price no longer reflects availability. When futures say one thing and real-world delivery says another, repricing becomes unavoidable. You can't settle industrial demand with narratives. You settle it with metal. Inventories quietly tell the same story. Above-ground stockpiles that once acted as buffers are thinner than they appear, and much of what exists is already spoken for. Leasing, rehypothecation, and paper claims stretch the same ounces across multiple obligations. That works until someone demands delivery. Then the math changes fast. Institutions are watching this closely. They understand that when a commodity with strategic importance enters a supply squeeze, price doesn't rise gradually, it gaps. The adjustment happens in bursts, not steps. That's why capital rotation into hard assets doesn't announce itself loudly. It moves quietly, early, and with size. By the time headlines catch up, positioning is already done. There's also a geopolitical layer that can't be ignored. Supply chains are being relocalized, alliances are shifting, and strategic materials are becoming policy tools. Silver sits